All right, Chapter 6, Individual Deductions. So we get a little deeper into those for and from AGI deductions here. So the first thing we want to talk about is deductions for AGI. The book talks about breaking down for AGI deductions into three categories. Those categories are deductions that are directly related to business activities, those that are indirectly related to business activities, and then those the last category is deductions that subsidize specific activities that the Congress is trying to encourage. Now, those directly related to business activities, taxpayers are allowed to deduct expenses incurred to generate business income. They must be reasonable and necessary, or ordinary and necessary and reasonable. We'll talk about that in a minute. So when you're talking about business income, what do you mean by business income? Is paying your house payment business income? Well, that seems like a silly question. Of course it's not. You'd be amazed how many, especially small business people, think that they can pay their house payments out of their business account and deduct it. Nope, can't do it. It's got to be business related. And so, when you think about activities that taxpayers do, you can break them down into activities that are either profit motivated or motivated by personal objectives, enjoyment, house ownership, having a nice car, things like that, personal objectives. Profit motivated. Here, you can have a couple of different activities. Those activities that occur within a trade or business, that's certainly profit motivated. But you can invest. You can invest in stocks. You can invest in collectible cars, paintings. You can invest in rental property. Both those things, both those categories are profit motivated. And although both are motivated primarily by profit, with one exception, business activities are distinguished from investment activities. Trade or business activities are those that require a high involvement by the taxpayer. If you've ever owned a business, or if you ever want to own a business, know that reasons for owning, you better have good reasons, because invariably it's going to consume your life and your time. Being a business owner is not easy, especially starting out. It may get easier as you go along, but as you grow, you're spending just as much time, if not more, as the business grows, if you're doing it right. Investment activities, not so much involvement. You buy some stock, you may sell it at some point, but that doesn't require a lot of activity. Certainly while you hold it and hope it appreciates, you're not involved in a lot of activity that's profit motivated. Same goes for rental property to an extent, although most individuals I've known that own rental property spend invariably way too much time on that. You wonder whether or not it's really that profitable, but that's up to them. But for the most part, investment activities don't require a lot of involvement. You just sit back and wait for the appreciation to happen, or collect your income, your dividends, your rents, whatever. And so, with the exception of rental and royalty activities, which are investment activities, rental and royalty activities are treated the same way as business activities, and thus both business activities as well as rental and royalty activities are both for AGI deductions, the expenses related to those things. Now they have to be reasonable, ordinary, and necessary, but they are for AGI deductions. Other investment activities. You buy stock, you hold it. That's an investment activity. Any expenses incurred are from AGI deductions. And so an example they use is investment interest expense. In other words, you borrow money, let's say, to buy stock. Well, in that case, it's a from AGI itemized deduction. And again, whether or not you're going to be able to utilize all that depends on all your other itemized deductions and whether or not they are greater than standard deduction. All right, so trade or business expenses must be directly connected to the business activity. They must be ordinary, necessary, and reasonable in amount. What does ordinary and necessary mean? Well, it means appropriate and helpful. I don't know if that really helps you understand what ordinary and necessary means, but it does not necessarily mean that it's a recurring expense. For instance, somebody sues your business. Well, the legal fees that you're going to have to pay certainly are ordinary and necessary for the business activity, meaning it's appropriate to hire an attorney to defend you, and it certainly is helpful for generating a profit, since you can continue to operate, hopefully in the future, without worry of this lawsuit consuming you. But notice legal fees are certainly understandable. If you're in business, there's a good likelihood that someday you'll get sued for something, but it certainly is, for most companies, not a recurring expense. It's a seldom used expense. Reasonable in amount means you can't pay more than what a normal taxpayer would pay under normal circumstances. Usually, taxpayers get into problems there with these business expenses when they're paying family members. They're paying their teenage son or daughter $50 an hour, or a salary of $50,000 to sit there and do nothing. Well, that's not reasonable, and so the excess amount over what you would pay an average teenager, hopefully to do something within the business, is going to be excess amount and not deductible. Well, if you look at a Form 1040, where exactly do you deduct trade or business expenses? Well, it's not on 1040. It's on Schedule C, which you attach to 1040. Schedule C requires you to list all your business income as well as your business expenses in Part 2. And so it looks very much like a profit and loss statement, income statement, and then whatever the bottom line amount, either net income or net loss, is transferred to line 12 of Form 1040. As far as rental and royalty expenses, again, these are investment expenses, but Congress has deemed that these are deductible for AGI, even though they're investment expenses. And so you also get to deduct reasonable, ordinary, and necessary rental and royalty expenses. Here again, you don't do it on Form 1040, other than you use Schedule C, or excuse me, Schedule E. Again, you report your income and expenses on there, and then transfer over the bottom line figure, net income, net loss, to line 17 of Form 1040. Well, if you recall, in the last chapter we talked about flow-through entities, how if you are an owner of a partnership, the partnership itself files a Form 1065 information only return. The partnership creates K1s for all the partners so that each partner knows their proportional share of income and deductions of the partnership, and they report the income, their proportional income and deductions, gains and losses as well, from the partnership on Schedule E as well. And if you have other rental and royalty income and expenses, you're going to include all that on Schedule E, and whatever the bottom line gain or loss is net income or loss is also in Schedule E and transferred to line 17 of the Form 1040. Now we've talked about losses, capital losses here, but we haven't really talked about trade or business type losses. You can dispose of trade or business assets at a loss, and if you do so, you get to deduct the loss for AGI. Losses from investment assets, which are capital assets, you've already learned, and you'll learn some more in Chapter 7, are offset against capital gains. If capital losses exceed capital gains, this is called a net capital loss, and you get to take $3,000 of that net capital loss and deduct it for AGI each year. Any excess over the $3,000 in net capital loss is carried forward indefinitely to subsequent years and used, again, subject to the $3,000 limitation each year till it's used up. Now there's a new thing out here called the excess business loss limitation. It's new for 2018. You will not be responsible for anything other than to know that excess business loss is the excess of aggregate business deductions over the sum of the business gross income plus $250,000. For married filing jointly, it's $500,000. And so it's not deductible, the excess. It's carried forward as a net operating loss to be used in future years. But again, we're not going to cover it. There's a section in this chapter later on, but I'm just not going to cover it at this point. Next, we want to talk about deductions for AGI that are well, I guess it's still related to business activities. Health insurance deduction for self-employed taxpayers. If you're self-employed, you don't have an employer paying your health insurance premiums. So Congress sought for self-employed individuals to give them a tax break by allowing a 4 AGI deduction for premiums paid for health insurance for self-employed taxpayers and their family. Now here, in order to be able to deduct this, the self-employed taxpayer must not be provided any or eligible to be provided any other employer-provided health insurance. And so let's say you have a self-employed taxpayer who has health insurance, but their spouse has insurance available through their company. Well, you can't get both. If you're eligible to be covered by an employer-provided health insurance, you want to elect to take that because you're not going to be able to, the self-employed person's not going to be able to deduct their health insurance premiums. Self-employed taxes, self-employment taxes. When you are self-employed, well, when you're employed, let's start with that. Your employer is responsible for 1/2 of the Social Security taxes and Medicare taxes. The employee is responsible for the other 1/2, and so your employer takes 1/2 of the Social Security tax out of your paycheck. Now again, this is Social Security and Medicare. It only says Social Security here, but it's both. And so the employee is responsible for 1/2, the employer is responsible for 1/2. Well, if you're self-employed, you're responsible for all, right? So in order to give equity to self-employed individuals, Congress has given self-employed individuals a 4 AGI deduction for the 1/2 of the self-employment tax. So in essence, by doing that, they're giving equity to self-employed persons with employed persons. We talked about this last chapter, alimony payments when the divorce decree is pre-2019 are deductible to the payor and taxable to the payee after 2009, well, starting January 2019, when the decree is post January, well, December 31st, 2018, really. If the decree starts January 1, 2019 or thereafter, there is no 4 AGI deduction for the payment of alimony. Bottom line. Next, they talk about, they don't, seems like they just keep it going here, but next we want to talk about deductions subsidizing specific activities. A lot of those things we just saw are somewhat related to business activities. And I think that started at health insurance deduction for self-employed taxpayers. So just keep that in mind. These next couple of deductions deal with specific activities that the Congress wants to encourage taxpayers to pursue. And so the first one is the deduction for interest on qualified education loans. Now these expenses have to be related to tuition, payment of tuition and fees, books, and expenses required for enrollment, room and board, and other necessary supplies and expenses, including travel. Pretty broad, in other words. And so if it is a qualified education loan, and this is for the taxpayer, spouse, and children of the taxpayer, the taxpayer can deduct interest expense that's paid during the year up to $2,500. However, that $2,500 is subject to a dollar for dollar reduction if they're, well, depending on their filing status, if their modified AGI is above a certain amount based upon filing status. And so if you look at Exhibit 6-4, it tells you what the filing status is. For a taxpayer other than married filing jointly, it's $65,000. So up to $65,000 for a non-married filing joint taxpayer, you can deduct up to $2,500 interest expense for the year as a 4 AGI deduction. For married filing jointly taxpayers, it's up to $135,000. Now, if your modified AGI is greater than 65,000 or 135,000 for MFJ, but below 80,000 or 165,000 for MFJ, you have this phase out amount. And notice that if your modified AGI is equal to or above 80,000 or 165,000 for MFJ, you've now, since it's a dollar for dollar reduction, you've reduced it to zero. So you get no deduction. And so there in panel B of Exhibit 6-4 is your phase out percentage. So they have an example there, 6-8. Make sure you look at that because it shows you how to do the calculation using your phase out percentage in panel B. All right, next we want to talk about deductions from AGI. We will take a break and get started on that in a few minutes.